Hi everyone, this is Tim Melvin of the Tim Melvin Deep Value Report and Banking on Profits newsletter, coming to you from down here in Central Florida, where it looks like we're getting ready to have some afternoon rain set in down here. So knock off some of that 96 and 97 degree heat we've been having in the last few days. Anyway, it's been an interesting week around Shane Melvin this week. The wife, of course, is off for her annual trip down to South Texas to hang out with her dad in Rockport, Texas, one of my favorite towns in the whole wide world. It's very hard to get to the town. It lays right on a bay leading out into the Gulf. The fishing is great. The beaches are great. He lives in a great house with fantastic views, with all the nieces and nephews and cousins and just running around. It's impossible for me to get anything done. So I stayed home this year. The dog and I are just kind of hanging out to her dismay. Naturally, the minute she went, my inner klutz came out. We managed to break the eyeglasses and went looking for the spare and realized that they were in the beach bag from when we went to the Springs a few weeks ago. The beach bag, folks, is in Texas, so I'm just going to walk around and look like an Uber geek until she gets back. No point spending $600 on replacement glasses that I only need for about 4 days. So, anyway, as I come to you, the markets are still working higher. You got the S&P 500 up about 1.5% over the past week. The All-World URTH index is also up 1.5%. And the leader is, no surprise, the Community Bank Index, up 1.7%. Those stocks are continuing to crush the market. They're going to continue to do so, and we'll talk about those a little bit more. If you're not in them, I certainly do not know why not, and I wish you would join us over at Banking on Profits, because there's still a lot more money to be made in these small community banks. Anyway, looking at the news, I was talking with an old friend who's been around the business as long, maybe even a little bit longer, than I have the other night. With everything coming out of China, they're throwing just everything at the wall to keep that Shanghai market from crashing. Basically, it's illegal to sell stocks in China on the Chinese exchanges. They're trying to stop the tidal wave of selling that hit last week. So far, it's working. I've never really seen government intervention in the stock market work for an extended period of time. So we'll see if this does. China's kind of a different duck, and the government has a little bit more control. We'll see what happens. Should that spill over at all into global markets, it's problematic. Then, of course, we have the leveraged buyout of Greece. It's the only thing I can call it. The terms and conditions that the Eurozone have issued to Greece basically take away Greece's sovereign state. They're a hostage to the Eurozone. And they're basically doing what they're told. Now, I can't say that's all wrong, because nobody forced Greece to borrow all that money to avoid collecting or raising taxes from its citizens, and to have the most benevolent pension plan, I think, in the world. People retire extremely early, and to kick it off, they got the great Mediterranean lifestyle and diet and all that fun stuff, so they live longer. So Greece is a mess. Yes, it's problematic that the terms and conditions are somewhat onerous, but again, nobody forced them to borrow that money. We'll see how our little Greek banks. I'm not feeling real confident about those at this point in time, to say the least. Thank goodness it is a fairly small position in the portfolio. You've got oil prices are falling again. They're going to fall more because we've just made a deal with Iran. I haven't seen all the terms, but the initial look at it says it's not really a good deal for the West. I'm not sure why we made it, but it is going to introduce more Iranian oil into the market. That could push oil prices even lower in the weeks ahead. And this morning, and I don't know why, but they call it a negative surprise in retail sales. Are these people, do they ever leave their office and go out and walk around and look at what people are doing, how they're spending and where they're spending the money? Because I can tell you, we live in a nice neighborhood down here in Central Florida. And, I walk around, and the first thing that you notice, people are being much more careful about how they spend their money. There's not widespread strong consumer confidence in the economy or the jobs market right now. It's starting to show up a little bit in the retail sales numbers. We've had great gains in auto sales, but that's really had a lot to do with reaching the end of the replacement cycle. The average American automobile is pretty old historically right now. And the fact that we're back to having FOG and mirror financing. Basically, if you stand upright and sign your name, they've been giving you an auto loan over the past couple of years. So I think that's made things look a little better than maybe they really are out there. And of course, lower gas prices is going to play a part into the lower retail sales as well. It's all a better but not good economy. It's been that way for a couple of years. I don't see it getting any better anytime soon. I can tell you that if you took this wave of news and you took it back, and let's just say 10 years ago, much less 20 years ago, this news all coming in a combination. Greece, China, troops massing on the border in Ukraine again, falling oil prices, lower EPS estimates for the S&P 500, projecting a negative quarter. We'd have had a pretty epic crash by now. Money would have flown out of this market at an incredibly high rate. That's not happening. It seems, folks, that zero interest rate policy really does trump all. Marty Zweig was quite right. You can't fight the Fed. Janet Yellen has kind of telegraphed to us that there's probably going to be one rate increase last year and then a slow and measured pace next year. But she always gives herself that out, that if the data changes, so will they. And I think there's a big chance that the data changes and we don't hit the very optimistic growth forecasts for the second half of the year. That could bring interest rate cuts back off the table. As I've said, she has the worst job in the world. They want to normalize rates. They want to raise them. They've been very patient about it. The economy is not cooperating with what they want to do, and I don't think it's going to going forward. We'll see what happens. But zero interest rates trump all. Lots of bad news coming at us from every angle, and so far all it's really done is reward the buy the dip crowd. Someday they'll buy the wrong dip, but until then, they're making tons of money, so it's kind of hard to argue with them at this point in time. Now, we're coming into earnings season. It's going to be, I think, a little bit predictable. They are looking for a 4.4% year-over-year decline, the first one since 2012 in quarterly earnings. There'll be lots of reasons and excuses, but, folks, the truth is, the sales numbers haven't been good in a long time. An awful lot of what you've seen in earnings growth over the past couple of years has come from cost cutting, stock buybacks, and other financial engineering methods. Eventually, that's going to catch up with them. This might be the quarter that starts to happen. As always, we'll see. The small bank earnings, they're going to be fantastic. We already got our first small bank report this morning. They got a 40% year-over-year earnings growth. We're going to see a lot more of that. We're going to see more loan improvements. We're going to see a little bit more money coming out of loan loss reserves. We'll see dividend increases, stock buybacks. It's going to be another solid quarter for the community banks, I think, especially compared to the larger banks for the quarter. So it's going to be fun. We'll see how earnings season treats us. As always, we're very opportunistic in earnings season. We think that I think it's ridiculous that we put so much emphasis on this one little 3-month period of a corporation's lifespan. Corporations' lifespans are measured in decades, not hours, minutes, quarters, or really even years. So the amount of money that's going to be wagered, won, and lost on one little 3-month period in the history of a corporation is absolutely ridiculous. But we do sit here like the vultures that we are, and we're hoping that we get some good, decent companies that miss earnings, disappoint Wall Street. The big funds sell it. They just dump the stock, push it down to unreasonable levels where we can step in and get happily involved and, watch the stock recover and, earnings pick back up, the conditions improve, and, of course, the stock price goes higher over time. That's what we do in earnings season. I'm not going to, try to predict what some company's going to earn, and then on top of that, predict how the market's going to react to how the company actually did. It's a silly game. Retail traders are going to lose a ton of money. My professional option and stock traded buddies love this period of time because they're just constantly scooping up dimes, nickels, and quarters from the uninformed public, making mispriced bets based on earnings season. Please resist the urge to do that, particularly in the options market. I tell everybody, if you're trading in the options market, always remember this. You're trading against the guy with 2 or 3 math degrees, bunch of supercomputers, special air conditioning to cool the computers off. So for you to really think that you're going to consistently out-trade that guy is probably a mistaken assumption on your part. So as they used to say at the end of Hill Street Blues, let's be careful out there. Now, let's see. Finishing off the week, life's gone till Saturday, so it's real big party time around here. We've got the All-Star game tonight. Dog and I are logging 5 or 6 miles, getting out there walking quite a bit. Of course, the new Harper Lee book, Go Set a Watchman, came out today. The reviews have been mixed. I'm anxious to read it for myself. Always did love To Kill a Mockingbird, and this has some alternate universe aspects compared to Kill a Mockingbird, apparently, with Atticus Finch. Perhaps not aging very well and being a bit of a curmudgeon in this book. So as a curmudgeon myself, I'm kind of looking forward to reading the book. We also have new titles out by Christopher Reich, Stuart Woods, and I'm still working my way through the very excellent Happiness, A Philosopher's Guide by Frederick Lenoir. That is a great book. Been reading it like half an hour, 45 minutes a day around all the fiction-based stuff that I like to do. Anyway, the big news, we're really focused on the small bank trade. We are starting to add some closed-end fund arbitrage because we've noticed that bolt-on investors, SIT, and a few others have entered into some situations lately that have pretty sizable discounts, and they're working real hard to force either the liquidation of the fund or a tender offer at a price close to net asset value. These things are paying 8-9%, so we go along a couple quarters, we own them, we collect the dividends, and then we're able to tender at a price 12 to 15% higher than the current discounted price. That's just a very successful trade, and it's not really dependent too much on market action. So we're adding a little bit of that to our repertoire as we move into the summer. Anyway, that's about all we've got going on down here. I've got to run to the store. It's just about lunchtime here, and I will talk to you guys next week. Again, this is Tim Melvin of the Tim Melvin Deep Value Report and the Banking on Profit Service. Have a great week, folks.